Well, Frank, looking forward to getting a podcast in together. I think we've got a good topic today, something that, of course, is on the minds of a lot of investors. And the big question is, hey, do I undertake this financial task, this investment management task? Am I going to manage my own money or am I going to hire a professional? I think what I'd love to talk to with you about today is, hey, what are the benefits and why should someone really consider hiring a financial advisor? And then I think we should discuss the things that they really need to look for when making that decision.
Sure. I really think that there's something that everyone should consider when making that decision is that if they're thinking of doing it by themselves, I want to make them aware that there is free service out there. You can find people that are willing to manage your money at absolutely no charge. Now, there's a couple of disadvantages. One, it will still take you probably a couple of hours a day of your time just to oversee everything and make sure it's going on course. Because keep in mind, this person's working for free. A few downsides to that would be that they probably are not going to be able to afford to get good data. The databases available are usually run in the hundreds of thousands of dollars, and certainly no individual is going to do that, certainly not someone working for free. But then again, there are things like Google Finance and Yahoo and MSN. They all have finance sites, so you can get a little information from there. You can always tune in to Jim Cramer on CNBC, and you can get some advice on either what to do or do the exact opposite, one or the other. And, there's probably the only other disadvantage perhaps is that it eliminates a lot of the private equity and private debt, things like structured notes, which people probably are not that familiar with, but those are the kinds of things that are not available to individual investors. The other part of the decision, I guess, is when you're letting someone do this for free, you have to understand that these people, and it is your life savings, but they've never done it before. So I can introduce you to them, but you have to understand that it is their first time doing this. And if you're interested in meeting them, I invite you to look in the mirror because that person is you.
That's exactly right. And I think that's something that is so important for investors to think about and think through that process is, hey, a lot of people think that they can do this themselves, and actually going through the undertaking of doing it and understanding all that's involved goes a lot deeper than, hey, let me just throw my money into a brokerage account and hopefully I can figure it out via the however many hours a day that an individual actually wants to spend taking care of their finances.
Yes, and then there's always the tax burden, because that's the thing that seems to be forgotten by most individuals, and actually a lot of people out there that are wealth managers and such. A lot of them don't have a whole lot more experience at managing the money. A lot of them are pretty good at doing your financial plan, but that's not a real difficult piece of the equation, doing a plan. But still, and a lot of them use outside services, somewhat like use our service, for instance, to manage their clients' money. But and a lot will just use mutual funds and ETFs, but there again, you're paying another layer of fees because you have the mutual fund manager and the fund expenses or the ETF expenses. So you're still layering on extra fees that you don't realize even if you're doing it yourself. And then one last thing on that would be the taxation, because certain investments bode very well in after-tax accounts or your taxable account, and others in your IRAs or Roths. If you have something like a CD where it's paying interest, certainly you want that in an IRA or a Roth, not in a taxable account, because you'll pay tax at income tax bracket every year on that interest. Other things like real estate investment trusts, some of them do better in an IRA because of the way they're taxed, especially those that are really done on mortgages and such. But others that own the real estate, the way real estate is taxed, they would be better off held in your taxable account because a good portion of that is depreciation, and that takes away from the tax you owe. And it allows you to pay long-term capital gains tax at the time that you decide to sell the investment or just down the line. So it's tax deferred, and then it's tax deferred at a lower rate of taxation.
Right. And I think a huge point of getting into this and what a financial advisor can do and what we think is really important to have in a financial advisor, such as ourselves, is a fiduciary. And so for any of our, listeners who aren't familiar with that, a fiduciary is legally obligated to act in the client's best interest. And I think that's critical because of all the things that you're saying is, as a fiduciary, we're going to do everything that we can in our power to make sure that our client's financial situation looks as good as possible, acting to make sure that, our interests are aligned with theirs. And I think a big portion of that is important to touch on is looking for an advisor who is, a fee-based advisor, because whenever you're charging on a percentage, a specific percentage based on AUM, your goals are aligned with those of your advisor. And so the more your account grows, the more that, of course, you're making, benefiting from the portfolio valuation, but also the advisor is incentivized to make sure that those assets grow over time. And with removing certain fees that, are not adding to the portfolio value, I think is extremely valuable.
Yeah, it's that old thing that we do better when you do better.
Right.
Well, you mentioned the fees, and that fee base makes sense because both parties are in a line. If one's doing better, the other one's doing better, or vice versa. And that brings me to the thing that, especially a retiree or near retiree, that I see very often is that they end up, and don't let this happen to you, is I see too often is that someone ends up buying a whole bunch of annuities. And annuities aren't liquid. They aren't even taxed very well. They're sold as being tax advantaged, they're tax deferred. Well, sometimes I'll see a variable annuity, which is just a bunch of mutual funds anyway. You still have the ups and downs of the market. And I'll see it in an IRA or a Roth. Well, that makes absolutely no sense because you could buy the exact same mutual funds in your IRA or Roth as in the variable annuity. But the variable annuity tends to have what they call, usually it's about 1.75% per year of they call mortality and expense. So that extra 1.75% is coming out, not buying you anything. Other annuities, say a fixed rate annuity where it's just kind of like a multi-year CD or something. Downside of those, I would say, is that typically the annuity will be fixed, and you say you get 5.5%. Well, it may be guaranteed for the first year, 2, 3 years, but you're locked into this thing for 7 or 10 years. And by the time you get on further out, you tend to find that you're getting less and less of a market rate, but you're stuck in the annuity. And if it's in an after-tax account, well, then that means when you start taking the money out eventually, that the gains come out first as fully taxable at income tax rates. So yes, you tax deferred it, but you didn't tax defer it like something where you hold a security for a year and you get long-term capital gains rate. So you're paying half the rate or even less than what you pay as income tax rate. You're paying full income tax rate, so you could be paying whatever your rate is, 25, 35, 40% tax on those gains, even though that they've been deferred for 10 years. So the taxation doesn't make sense. I would just, in most cases, I'm not saying never, ever, ever is an annuity a good answer. I'm just saying seldom.
Right. And I think you made a really good point. I think a huge part of what a financial advisor, and something that you and I focus on a lot, is that taxation piece. And something that you kind of alluded to earlier when you're talking about being your own financial advisor or investment manager is you're not necessarily doing the tax loss harvesting or the tactical investment strategy that we like to do, as everyday investors. And I think being able to capture tax losses along the way is one of the easiest ways to attain that alpha over market appreciation. Because what we talk about a lot is whenever you're just in a couple of ETFs or a few mutual funds, you don't have opportunities for tax loss harvesting along the way. I mean, you and I, we invest in individual securities so that if something at some point, for whatever reason it may be, drops in value to some extent, we have the opportunity to sell that, create the tax benefit along the line to offset the gains from the rest of our portfolio, and use those tax losses as a way to outperform the market on an after-tax basis. So I think between that and just taking advantage of market movements, being tactical about how we buy things. I know we were talking about this earlier, is that an individual equity or a bond or some kind of investment may drop substantially because, say, it's a piece of news or a piece of earnings or something that creates a market dynamic where the value of the asset is dropping what we think is too much. It gives us an opportunity to buy something at a lower price that is going to give us appreciation in the future. And maybe it is, maybe the news is worthy of that kind of drop in valuation. But a lot of times, especially in the current market, I mean, you've got huge market swings in individual securities. A lot of that, is due to liquidity reasons or other, but gives us an opportunity to buy into things that an individual investor investing in, a broad-based index or ETF doesn't have the opportunity to do that.
Yeah, there's another thing about individual securities that I encourage people, because certainly the tax swaps, tax loss harvesting can be done. Whereas in a mutual fund, you could lose 20% a year and still come January, you get a big 1099. But another big thing is that it's a lot easier if you own 30 or 50 individual securities. It's just a lot easier when the market isn't acting just right. It's a lot easier if you really understand those 30 to 50 companies really well, and you say, hey, if this is going down right now with the market, maybe it's a better opportunity to buy some more. Whereas if you just own the S&P 500 or the NASDAQ or the Dow or something, just big indexes, when the market's going down, what kind of conviction can you have? Because typically the S&P, when everything's going well, 30% of the S&P 500 is probably losing money. Right. So it's hard to have conviction in that 30%. As a matter of fact, I'd like to avoid that 30% and concentrate on the S&P 350. And even beyond that, there's maybe 50 or 100 really good considerations out of the 500. So focus in on that. Spend your time. If you're going to do it yourself, well, spend your time there and look deeply into the companies, not just at you see something in the marketplace or you hear something on TV or something, or even from a friend or a relative. Typically, very often, that's the worst advice you'll find. So do it yourself. And one last thing I'd say that you should look at is, we don't talk about it very often, but it's something you really need to do, is look at someone's debt structure. You find a good company. Sometimes they have very little debt and they're a great company. Sometimes they have a lot of debt, and it's a big concern if that debt's getting ready to roll over in the next 12 months and we're sitting here at fairly high interest rates. You're going, well, their 3% and 2.5% debt that they've been carrying is now going to get refinanced at 5 and 6%, maybe higher. That same company, maybe they've managed their debt fairly well, looking at how low rates were a couple of years ago, and refinance, and perhaps they don't have any debt or not much debt even coming due for 5, 6 more years. Well, that's a big difference between that same company and short-term rollover of debt.
Right. And I think that's what our listeners should be looking for whenever they're looking for an advisor, is someone, especially on that investment management side of things, who's buying those individual securities that gives, like I said, the opportunity for tax losses and tactical investing, but also the ability to know your portfolio. I mean, you have, as an equity owner, you have a portion of ownership in this company. A lot of people forget that stocks are not just pieces of paper. You actually own a portion of this company. And so you should know, and this is what we like to do, is really lead with education whenever we're communicating with our clients, is know what's in your portfolio, why you own it, and why, like you said, if there's a market pullback, why you should stick along for the ride, why these are still valuable. You still own this percentage of the company. It's not a piece of paper going down in price. This is a company that we're talking about. And I think that's important to remember.
Yeah, and it's also, I think, very often people say, well, what's your sell discipline? Or how often do you rebalance? Well, I want to tell you, if you're out there doing it or you're talking to someone and they start talking about rebalancing. I remember when rebalancing came on the scene and people would say, well, we rebalance every year. So I don't know if that means every December 1st or every April 5th or what, but every year. And then someone else came along and said, well, you know what? We work twice as hard as that. We rebalance twice a year. And then someone else, all of a sudden it became quarterly rebalancing all over the place. I'm going, well, why in the world would you sell your best performing assets because the calendar changed? So it's a new date and you say, oh, it's time to rebalance. I need to sell my good performing things, the ones that have outperformed, and bring them back down into balance so I can own 9% of each of the 11 sectors, or however you're splitting it up. And so you're selling your good performers, paying short-term capital gains tax on that sale, and buying more of your weak performers. Well, that would have been the equivalent of these days of selling your AI stocks that are going through the roof and buying more utilities or buying more of whatever it is that is dropping in that environment, because very often it's not something as life-changing as AI, but sometimes it's just, is the Federal Reserve, are they raising interest rates? That puts some sectors of the economy at a big disadvantage. And you'd probably like to avoid those at that time. Certainly technology doesn't like that because it carries a lot of debt. Real estate doesn't like higher interest rates. So you can kind of start thinning out and avoiding those for the most part, and going towards things that really like having higher interest rates to those sectors. That doesn't change every quarter. So it makes no sense if the Fed's lowering rates or they've stabilized and you expect them to lower. That doesn't happen on a calendar basis. It doesn't change every quarter, so it makes no sense to rebalance. I think that's one of the worst concepts in finance.
Right. I think betting against your winners and betting for your losers is certainly something that is somewhat unique to the finance industry, but you hear it all the time. And like you just said, I mean, there's a lot of reasons to not operate a portfolio like that. And I think you also made a really good point about doing the research, looking at the data. You mentioned debt earlier, and I think a huge portion of that is finding an advisor, an investment management group that has the data and to look at these individual things. I mean, having those institutional level databases, research tools, information makes the investment process so much easier, in the fact that you have access to all the information that you need to have access to. I think a lot of retail investors are trying to look at companies themselves, whether or not they have some training or background in finance. It's very difficult if you don't have access to the right data and information. And now we've talked about this on prior podcasts, but the AI implementation piece is also huge when it comes to that. Hunter and I have talked about how, implementing AI makes researching these companies so much more streamlined. You have access to more information. You can consolidate that data and information much faster and easier. And I think it's important to be looking for an advisor who is using these kind of tools to better their investment process.
Yes, I can say that for all these reasons, that what I used to take 50 or 55, I think at the height we had 55 analysts. We can now do with 3 or 4 analysts more work in a week than we could with 55, 25 years ago. It's truly amazing.
No, definitely. I think that having the access to all this information makes that so much easier. Like we said, you can do so much more with fewer people accessing more information now, and it's pretty incredible.
I wanted to say one more thing about that too. I think the right investment manager is someone that can do this in house, because we kind of touched on the fact that you're avoiding outside fees and such, because certainly there's going to be a lot of managers that are going to farm it out to firms like ours, and now you're paying for that manager and an outside management thing, no different than mutual funds and ETFs.
Yeah, that's a really excellent point that I think a lot of investors, when looking for a financial advisor, do not realize is that a lot of those people are just sending this out to somebody else to do the management. And that's where you incur that layering of fees. So whether that layer of fees is coming from mutual funds or it's coming from outside managers where the person that you're talking to is not even managing the money, I think that's really important, something that people should pay attention to.
There is one other thing too to look at in your own portfolio if you already have someone outside, especially if it's one of the big firms. And that is big firms charging you a fee, no different than we would or many others, based on your assets under management. But then on top of that, putting in their own products, and all of a sudden you see in there that they have a tax loss harvesting program that is really a mutual fund of their own that has all sorts of fees in it. So now they're charging fees within your portfolio, then a fee on top of that as well. So that's another thing to keep an eye out for.
Yeah, I think asking these questions of a prospective financial advisor, financial manager is really important. Say, hey, what kind of fees am I incurring? What kind of your own products are getting put in these portfolios? Are you doing the investment management in-house? All of this stuff is really important.
Are there commissions on top of this?
Definitely. And I think the last thing that, I think can kind of wrap us up, that we can kind of conclude on, is that, once you've accumulated a certain level of wealth, whether you're in retirement or you're still running a business or high up in management somewhere, being able to offload the responsibility of financial advising and investment management can make life just much less stressful. I mean, whether you're still working and you're focused on your business, you want to have that time to focus on the things that really matter to you, not managing your portfolio or watching the stock market every day. And then if you're in retirement, you want to be able to go on vacation or do the things that you want to do, spend the time with your loved ones without being stuck to a computer screen. There's a lot of value that's built into that, call it, 1% fee more or less, that gives you that freedom of life to enjoy your time rather than have to try to figure it out all on your own.
There's also that final thing that I see a lot is that, and this usually happens more times than not, at least in this current generation of 70 plus year olds, is in that generation, it was more the male man of the house that did the investments or such. Well, what happens, even if it's the woman of the house that's doing it today, because things have changed in households, but if one person's doing it more than the other, what happens if that person is hit by a truck or something happens to that person? Is the other person then left to fend for themselves and figure things out? So even if you could do it as well, does it make sense from a loved one standpoint?
Right. I think the continuity is a big piece of that. And I think not only between spouses or partners, but also multi-generational, whether that's a client or you as an investor are concerned with, hey, I want to make sure my children are involved in the investment process. If me and my spouse or me and my partner pass away, I don't want to leave, these assets to my children or benefactors without them kind of, being somewhat involved in the investment process through some kind of investment manager or investment advisor. Well, I think we covered the topic. I think that the takeaways for our audience are really that so much can be gained from an investment manager who is really doing the things that we believe are important. I think, finding the right person who's a fiduciary, who's fee-based with no commissions, who's investing into individual securities and making sure that you're educated along the way is extremely important. You get so much value out of that. I think a lot of people don't understand the value that a good investment manager, good financial advisor can bring until they consider all these benefits. And we just hope that our listeners, gain something from this conversation.
Well, certainly, and I'll conclude with saying that even if you consider, in general, a 1% per year, for instance, fee, I would consider, in most cases, most people will find that better than free. It'll cost less in opportunity and in time, and even probably in returns.
Exactly. Well, Frank, thanks for joining me for the conversation. I enjoyed it.
Thank you.